Participants in secondary markets. Those who engage in the secondary markets fall into two broad categories: investors and facilitators. Investors. Investors are those who buy and sell securities in the secondary markets. They trade in order to accomplish their objectives, whatever they may be. In the secondary markets, the seller of a security is not the issuer. There are several types of investors. Take note, in most secondary market transactions, the issuer of the security is not involved. However, in the case of a buyback, the issuer of a security may buy the security from investors through the secondary markets. This is an exception to the concept of no issuers in the secondary market. Retail investors. Retail investors are the normal people who are investing their own money to accomplish their own objectives. They may be people of modest means or very wealthy, but they are the investors that are generally not professional investors. Most of the rules on disclosure, communications, and recommendations are designed to help the retail investor. Day trader. The day trader is generally a type of retail investor that trades rapidly in and out of positions. Most day traders will have all positions closed and will end the day flat with no positions in their account. Accredited investors. Accredited investors were covered in a prior lesson. The classification of accredited is used in primary market transactions, particularly for Regulation A and Regulation D private placements. The term has no specific use in secondary markets, but it is sometimes used to identify a wealthier or more sophisticated retail investor. Institutional investors. An institutional investor is a large investor such as a mutual fund, a pension fund, a bank, an insurance company, or some other financial service organization. The investment decisions for these institutions are often made by a professional, such as an investment advisor, who is paid by the institution to manage the institution's portfolio. Fiduciaries, custodians, and trustees. Certain types of accounts are managed by a custodian or a trustee. Don't try to find a specific difference between these two. The terms are used within the securities industry in different ways. However, both of these roles are fiduciaries. Test topic alert. A fiduciary is a person that manages assets, usually financial, for another person, a beneficiary. A fiduciary has a legal and moral obligation to perform her duties in the best interest of the beneficiary, placing the beneficiary's interest before her own. Custodian. On the exam, custodian refers to a person who manages a minor's account under the Uniform Transfers to Minors Act (UTMA) or the Uniform Gift to Minors Act (UGMA). Custodian may also refer to a firm that holds assets in a qualified retirement account such as an IRA. Trustee. A trustee is a fiduciary that oversees a trust. This might be a living trust, a pension trust, or any other sort of trust. If there is a trust, there will be a trustee. Guardians and executors. Guardians are normally court-appointed custodians over a minor or an incapacitated adult. Executors are custodians of estates. These roles might appear on the exam but are less common. Take note, a fiduciary may or may not be a professional, depending on the role and the type of account they oversee. Note that an investment advisor is always a fiduciary. Investment advisors EAS. There is a three-pronged test for who is an investment advisor. Anyone who 1 gives investment advice to as a regular part of their business and 3 does so for compensation must register as an investment advisor under the Investment Advisors Act of 1940 and the Uniform Securities Act. BDIS who provide advice for a fee are subject to registration under this act. Agents of IAs must register and pass the Series 65 exam or Series 66 exam for representatives with a Series 7. When acting in the capacity of an IA, the advisor is acting as a fiduciary for a customer. Example: a registered representative RR who is registered under the Securities Exchange Act of 1934 and has been charging commissions for transactions now wants to charge separately for investment advice. regardless of whether to do so, though already registered under the Securities Exchange Act of 1934, the RR would need to register as an investment advisor representative IAR by passing the appropriate exams Series 65 or 66. Take note, when acting as an IA, the IA represents the customer. If the same firm is also a BD, it can also place the trade but is acting in its BD capacity when executing a trade. It might be said that this advisor has switched hats from IA to BD. The representative who does this will be dual registered as an IA representative and as an RR and will be working for a dually registered firm IA and BD. Facilitators. Facilitators help customers perform transactions in the secondary markets. There are a number of different types of companies involved in the process of buying and selling securities. Broker-dealers BDIS. BDIS FINRA member firms perform securities transactions for their own accounts or for their customers. Their primary source of revenue is from transaction fees like commissions and loans. Each member firm BD operates under an individualized membership agreement with FINRA and possibly other self-regulatory organizations SROs. The membership agreement explains what lines of business the BD undertakes. After becoming a member, firms and their associated persons may never state that they are endorsed, approved, or recommended by a regulator. This prohibition extends to both verbal and written communications. Some BDIS offer all types of investment products such as stocks, bonds, mutual funds, options, and many others, while some limit the products they offer to only a few. BDIS can also incorporate proprietary trading, that is, to trade the firm's own capital. These firms stand ready to buy and sell specific securities, hoping to profit from price swings. Other firms will publish quotes to buy and sell securities and are known as market makers. Most firms service retail customers, but some specialize in dealing solely with institutional investors. There are three types of BD firms on the exam: carrying firms, fully disclosed firms, and prime brokers. Carrying firms, clearing firms. A carrying firm or clearing firm carries customer accounts and accepts funds and securities from customers. Carrying firms typically rank among the larger BDIS. They have the capability to do trade executions, clear and settle transactions, take custody of customer funds and securities, and handle all back-office tasks such as sending trade confirmations and statements. A firm carrying customer funds and securities clearly has a line of business that is inherently risky, and it is required to maintain asset levels called net capital higher than that of firms that do not accept custody of funds or securities. Take note, a carrying firm must hold separately customer funds and securities held in their custody from the firm's own capital and securities. They may not commingle the firm's assets with client assets. Fully disclosed introducing firms. A fully disclosed firm, or introducing BD, is one that introduces its customers to a clearing firm. The clearing firm holds funds and securities of the introducing firm's customers and performs related functions, such as sending confirmations and statements for its correspondent firms. Essentially, the clearing firm acts as the introducing firm's back office. Because the risk associated with holding customer funds and securities is not present, net capital requirements are lower for introducing BDIS than they are for self-clearing or carrying BDIS. Take note, introducing firms may take orders from customers and pass those orders to a clearing firm for execution. However, an introducing firm does have the ability to execute trades for its customers and often does, but the settlement clearing of the trade falls to the clearing firm. Example: carrying firms, sometimes called full-service firms or clearing firms, clear their own transactions. Smaller, regional BDIS are typically introducing firms, also called fully disclosed firms, that introduce their transactions to larger carrying firms to clear their transactions. In other words, very large firms, in addition to clearing their own transactions, may accept transactions from other smaller, fully disclosed firms and, in so doing, act as the smaller firm's clearing firm. Prime brokers. To understand a prime broker's role, you must first understand what a prime account is. This type of account allows a customer, generally an institution, to select one member firm, the prime broker, to provide custody and other services, while other firms called executing brokers may be called on to handle certain trades placed by the customer. Take note, prime brokers often execute some of their customers' transactions, but they have the option to send a trade to an executing broker. To open a prime brokerage account for a customer, a member of the prime broker must sign an agreement with the customer, spelling out the terms of the business relationship, as well as names of all executing brokers the customer has contracted with. The prime broker will then enter into written agreements with each executing broker named by the customer. The customer receives trade confirmations and account statements from the prime broker, who facilitates the clearance and settlement of the securities transactions. Responsibility for compliance with certain trading rules rests with the executing brokers. The key advantage of a prime brokerage account is that it usually provides a client with the ability to trade with multiple brokerage houses while maintaining a centralized master account with all of the client's cash and securities. A prime brokerage account often includes a list of specialized services such as securities lending, margin financing, trade processing, cash management, and operational support. Prime brokerage accounts are likely to be offered to ABD's more active trading clients, such as hedge funds, who may require a number of executing broker outlets to conduct their transactions and who can benefit by having margin requirements that are netted across all of the prime broker's positions. Test topic alert: BDs make money from processing transactions. A BD may act as a broker or as a dealer on a transaction, but they may never be both on the same transaction. Transfer agents: the transfer and registration of stock certificates are two distinct functions that, by law, cannot be performed by a single person or department operating within the same institution. Both functions may be performed by the same institution, and often are, but there must be a level of separation within the institution in the performance of the two functions. Issuers typically use commercial banks and trust companies to handle these functions. The transfer agent for a corporation is responsible for ensuring that its securities are issued in the correct owner's name, canceling old and issuing new certificates, maintaining records of ownership, and handling problems relating to lost, stolen, or destroyed certificates. Registrars: the registrar is always a separate firm than the issuer or a transfer agent. Registrars are licensed by the states and provide audit and oversight services for the transfer agents. The transfer agent maintains account of the total number of shares of a company that are authorized and outstanding. Depositories and clearing agencies: a clearing agency, sometimes called a clearing corporation, is an intermediary between the buy and the sell sides of a transaction. The clearing agency receives and delivers payments and securities on behalf of both parties. Any organization that fulfills this function, including a securities depository, is considered a clearing agency. Conceptually, this is similar to the way a bank clears checks between two parties. In addition to BDs, commercial banks can act as clearing agencies and depositories, as can corporations that are set up for the purpose of clearing securities transactions and taking custody of funds and securities. The Depository Trust and Clearing Corporation (DTCC) is the world's largest securities depository. It provides custody services for virtually all securities except those subject to transfer or ownership restrictions, restricted securities. Take note, the DTCC is a member of the Federal Reserve System and is not in the retail banking business. You can't open a savings or checking account there. The DTCC provides automated clearing and settlement services in a book entry format to banks and BDs for stock and bond trades, and employs a continuous net settlement (CNS) system. The DTCC and its subsidiaries also function as a central securities depository by providing custody and safe-keeping services in more than 60 countries worldwide. Another clearing agency is the Options Clearing Corporation (OCC). The OCC is the clearing agent for listed options contracts, that is, those listed for trading on U.S. options exchanges. Its primary functions are to standardize, guarantee the performance of, and issue options contracts. The OCC determines when new options contracts should be offered to the market on an underlying security. The OCC also designates the contract specifications such as strike prices and expiration months. These standardized features for options help to maintain uniformity and liquidity in the marketplace. Take note, remember, a BD is both a broker and a dealer but may not act in both capacities on the same transaction.